Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, and Ben Kingsley, chair of Property Investors Council of Australia and the 2014 and 2015 Property Investment Advisors of the Year.
All right, folks, you're on the Property Couch where each week Ben and I bring in the insider's guide to property finance and money management. Hello, Ben.
G'day, mate. How are we?
Very good.
That's good.
How's your week been?
Well, we've had an interrupted week. We've arrived back from the US.
We did.
Little quick trip over to the US and we came home. A little shout out to the ground crew at LAX Airport for the Qantas flight, QF94.
Mate, you should be sending them hampers.
LA to Melbourne. Let's just say my connecting flight didn't quite go to plan. And by the time I got to the service desk without even checking into the flight, I introduced myself as someone who would like to get on this flight. And they said, the flight's closed.
Yep.
And, leave it with us. So I had to sit and wait patiently thinking, okay, well, what am I going to do? Where am I going to sleep overnight in LA? Thinking that this is...
I had your phone cord in my pocket. Hey, I was a bit worried about you too, because you had to bolt from the domestic terminal to the international terminal, and I had visions of, oh my gosh, the poor man's back.
The calves are a bit tight.
X-ray? Yeah.
The calves are a bit tight. Yeah, 2.5 kilometre run through the little channels and tunnels that create up LAX Airport. But got this wringing wet. They're probably thinking, what's going on with this guy? He's got a backpack and he wants to get on this aircraft to go back home.
He's been in the US for 4 days and he's got no luggage.
So shout out to the great customer service from our good friends at Qantas. Once again, they just made it happen. So they opened the flight to let me grab a seat.
Did you do I'm on the podcast? So
No, I didn't want to just, keep it low. But yes, good job.
So, yeah, well,
thank you to those
good on you for
people
getting back. I didn't think that you were going to join me on the flight. I thought you were staying.
Well, that person in... whoever they rang, wherever you are, that got me back onto that flight. Thank you.
Yeah, very good. Hey, summer series, Ben. So we've had a few people reach out, which is terrific.
Good.
But there's
there's
one or two extra spots.
Yep.
So if people want to tell us their story of transformation, and for clarity again, Ben, it is just for you to tell us about you. There's no need to fluff anyone's pillows here.
No.
We just want our community to hear great stories of transformation.
Well, we've had some of that feedback, So again, we read the reviews, we read the feedback that we get, and some of the feedback was, love what you do. Couple of stories of how people have, implemented some of the stuff you've done would be great. Okay, so we're following what they're saying.
Well, the message is really clear here. You can help the community out if you come and talk, because everyone listens to Ben and Bryce and, it's okay for them.
Yeah.
But if they hear just the listeners putting this in place, they go, well, maybe that can work for me.
Beautiful.
So don't discount yourself. And I said it before when we put a shout out, Ben, we will look after you. We will make it really easy. Ivis looks scary, but we'll even make sure that she looks after you. I just said that because she never talks, so she can't do right or reply. But okay, and we've got a few things to read out here. We've got just in terms of the Money Smart system, Ben, that's going super, super well.
Yeah, it is.
The Money Smarts this is from Lindsay, the Money Smarts is the most practical system to keep your money working for you without you having to think about it. While it involves maintaining a certain level of self-discipline, it allows for plenty of self-permission when it comes to spending money on what you value.
Love it.
Thank you, Lindsay. This one's from Susan. I enjoyed the book and especially like the examples of the dollars you can save by using the Money Smart systems of saving your surplus funds and how using this system and paying an extra $100 per week off your mortgage can reduce your mortgage so quickly. It gave me inspiration. And this last one, Ben, there's a few here, but we won't go too many. But Daniel, it was great. I started listening to the podcast in January this year and have since completed 2 full laps.
Wow.
That's impressive.
That is impressive.
Daniel must be in a job where there's lots of car time, I would
have
thought.
Or downtime.
Actually, I finished lap 2 a couple of months ago. Sydney traffic sucks. Well, I should have read on. Sydney traffic sucks, but you 3, including Ivis. Hey, Ivis.
There we go.
You want to say anything? No?
Yeah, no. Thank you.
Make my long commute much easier.
Thank you. That was just me attempting to be honest.
I knew about Money Smarts from the podcast and thought it would be good for our family, but didn't quite know how to implement it until now, Benjamin.
I
read the book over my 2-week holiday in Japan, even reading in the Japanese baths.
Ooh, nice place to read.
Yeah, in brackets, I've got a few strange looks for that. Close brackets. I now have the motivation, information and confidence I need to implement the system for my household.
I can sort of understand that, right? In your birthday suit and you're reading a book. in the bath, you know, in a communal bath.
Mate, it circles back for the leaf.
You know, the feedback we've been getting, Bryce, is the number one secret to good money management is organisation of your money. So organising it into, in our case, the virtual jars.
Yep.
That has been what I see as the transformation. So that has been the feedback. So if you
those
haven't got
new
the
to the
recipe
podcast,
book,
it's Virtual Jars Ben's talking about is the book we wrote about the grandparent system of using the old school flower jars. 21st century, you need to use virtual flower jars.
Yep.
But now you can just implement it the same way your grandparents did. They
That's right.
rarely overspent.
Budgets don't work because the money's not organised.
Yep.
You organise your money, and that's the trick with the Money Smart system. Organise your money, you plan, and you implement, and you capture that surplus. So check it out. Recipe book is there for you. Could change your life.
Yeah, so Ivis will have some links somewhere, won't you, Ivis? There's a free chapter that you can get from the homepage, Ben, thepropertycouch.com.au.
And if you've read the book, so we've got some great reviews. Did you know, Bryce, I was doing the numbers.
It's not Did You Know Now, Ben.
No, I know that. Sorry, mate. We've got over 6,500 people using the Money Smarts online.
Yep.
6,500 people.
Extraordinary number.
So,
but there's
more.
25 million people, Ben. So we've got a bit of work to do.
We've got 12 million households. And you'd probably say there's some share households there as well. So I reckon there's 15 million people who can be helped. This is the crusade.
We've got a bit of work to do.
Bit of work to do.
So for those people who we read out and anyone who's using the Money Smarts, if you could just tell one person, that'd be really helpful and we can spread that message. Hey, we went over to the US, Ben, for a bit of personal development, learn a few things, which was great.
Yes.
And there was a speaker there, Erica Rocca, sorry.
Yep.
And this is for my mindset minute today, Ben.
Oh, good. Yep.
If you want to stretch yourself, you cannot have excuses. You can have obstacles, but no excuses. And so the point that he was making is people are going along. It's not as if people who are courageous actually demonstrate unbelievable strength and no fear. They actually feel the fear and do it anyway.
Yeah, they do.
So if you want to stretch yourself, you cannot have excuses. You can have obstacles, which we all have, but no excuses. An excuse is an obstacle you are choosing not to overcome.
I love it. So a little bit of courage. Take a little bit of courage.
So Ben and I, we have obstacles all the time, but we still just go forward and navigate them. So if you can relate to that, folks, chop out the excuses, just see it as an obstacle and just keep going because everyone faces obstacles, but the winners overcome the excuses. So there you go, Ben.
Thank you. That's a good start to the show.
Now today we're going to talk about 9 ways to navigate the credit crunch, Ben.
Ooh.
9 ways to navigate the credit crunch because people out there, if you are playing the long game, there's good buying opportunities out there, Ben.
There is.
Our team's bought wonderful properties last month.
In my Did You Know, Bryce, I'm talking about some of the confidence that might be hidden in the marketplace around that. So you have to wait till the end of the show for that one. Hang around.
I always think it's interesting in these times, Ben, where the same piece of real estate in FOMO environments, people are just climbing over each other to get it because 2 or more people want it. Now you can walk up the street and say, okay, I want that, and it's under less competition. You look around and you go, nah, I don't want it.
Yeah, if you don't want it, I don't want it.
But nothing's changed. We're still playing a 20-year game. We're still buying the best properties, the foundations of the properties underneath. So
put it this way, the gardeners, Bryce, some of the best investors in the world are gardeners.
Yeah.
Because they're super patient, right?
Yeah.
So they just tend to the garden, not worrying about what's going on.
Is this metaphorical? Or is
it's metaphorical, right? It's metaphorical,
okay.
right? So the theory goes that they just are very patient people, right? And then ultimately, they're coming out of their gardens at the moment because they're seeing opportunity.
Oh.
Right? But when everyone else is being frenzied, they just sit back and they just wait.
They do.
And then they tend to their garden and they have their lives, and then when the opportunity's there, cash is there, lending's ready to go, and they strike.
Mate, I like it when you have your oracle voice on. Just drop a little bit of wisdom into the podcast there. Very good. So,
so what's number 1, Bryce?
Number 1, Ben, you've got to acknowledge that the landscape has changed. There's no point putting your head in the sand. APRA has done some work, and it's something that you need to acknowledge, that investing in the next 3, 4, 5 years is within a different environment for what we've experienced, and you've just got to acknowledge that.
You do. I think what we've got to recognise is that the combination of RBA sort of just being careful, APRA putting some macro-prudential changes into the marketplace as well has stifled demand, especially investor demand. Royal commissions, productivity reviews, and the Royal Commission being critical of the regulator, right? So that is, ASIC is the regulator of responsible lending. And so I like the way in which ASIC and the ACCC and all of those regulators potentially work in with business to try and get a good result, right? But sometimes, if you see these types of changes occur, we could go from a consultative process to a more firm, aggressive, my way or the highway from the regulators, and that's dangerous for economic prosperity, right? Because if we get too close to the extremes of everything needs to be absolutely perfect, borrowing and lending could potentially slow down, and that we've already seen what's happening to the property prices with APRA's intervention. So my view is I hope the government is listening of the day, whoever that might be in the future, and we get the balance right, you know, so we don't go from one extreme. It's a bit like the reviews that we saw from the Victorian Labor Party around changes to Tenancy Act. So, yep, there's no doubt that the landlord who owns the asset probably had quite a lot of control, right? And so tenants did feel that they were being a bit squeezed.
Pendulum's the other way.
Pendulum's gone completely the other way, right? So the answer's somewhere in the middle. And so we're hoping that through this, that we see those types of changes and common sense come into the conversation. Because for me, and I've said this publicly on the podcast before, that APRA has the ability to, and same with all the other regulators, to make the landing softer rather than it continue to be harder. Now, if Labor get in and we see negative gearing and cap, then it's going to be harder again, right? But ultimately, the regulators can make a difference. We've seen it, right? You know,
they can release the handbrake.
Correct. Well, you know, demand was too great, supply couldn't match demand, asset appreciation, right? We'll never be able to deliver hundreds and hundreds or thousands of properties each week because they take a lot to build, right? You know, it takes time to build. So that's where we want it. So I'm saying to APRA that enough might be enough, right? I think you've done good work here, but I definitely feel in terms of if we look at the delinquency rates across lending and so forth, that there hasn't really been, you know, in terms of historical terms, those delinquency rates are absolutely at historical lows, right? So they're coming off a really low level. So they've put this measure in purely not for, you know, for future risk as opposed to the existing risk that was in the marketplace, but they could.
Yeah, that's right. Well, you need advice now more than ever to navigate this landscape because compliance is really, really high. Things are taking longer. The banks are a little bit concerned about what's happening with the Royal Commission. So if you were able to get loans through quick in the past, it's noticeably slower a bit.
It is
noticeably slower.
Totally slow.
So you need someone who knows how to navigate that. So number one, just acknowledge that the landscape has changed. Number two, you've got to think 3 steps ahead, Ben. We've used this analogy before about the game of chess, but a lot of people talk about a borrowing capacity. We'd rather talk the conversation to a borrowing strategy, and sometimes that means that you take 3 steps back to go 5 steps forward, because it does take slower to undo some of the stuff that's going on. And I think that's important because, you know, I played chess with Jack, my eldest, and so the thing that I'm teaching him now is he's always just looking at the next move, right?
Yeah, to take a pawn.
And I'm saying, mate, you got to set up the next move and then worry about where you land with that chess piece, because I might have something that I can do. So it's a chess game, right? You have to actually think, what do I need to do in the overall bigger picture here, and then plan for that accordingly so that you don't get your pawn or your bishop or your queen taken out when you're not looking.
But here's the point, Bryce. How do I do that if I don't know what I'm doing, right? Like ultimately, you know, I can read up about chess just like I can read up about lending, but there's not a lot out there around strategy and tactics. There's a lot around, this is what an offset account does. This is how a redraw works. This is how you set up maybe your banking, right? But a good example of that now is, you know, and following on from the acknowledging that the landscape has changed, we absolutely know that the client objectives, in other words, working in the client's best interest, is now high on the radar of the regulators, right?
As it should have always been, but wasn't.
Yeah, well, it was, but I mean, I'm giving credit to ASIC and that in terms of when they implemented the NCCP, so the National Consumer Credit Code, it was new territory, right? Yeah. And there's a lot of great debate around what is reasonable and what's in the client's best interest. And we're going to unpack a bit of that later in this episode. But the point I'm making there comes back to the landscape has changed. So before you go for a loan, you are absolutely going to be squeaky clean for 3 to 6 months on your actual spending and transactional story, right? That's an important point.
Yeah, absolutely. So the point here is when people come in and they shop on rate, Ben, that's borrowing capacity. That's not borrowing strategy.
Yep.
Because sometimes when we put a borrowing strategy together, it actually is possible to get a cheaper rate. And if that's all that's important to you, well, that's what you'd go for. But if you take a step back and have a look at the bigger picture, you may, in some cases, not always, pay a premium on rate to get better facilities, get better access to your money, to be able to control it, to be able to control your cash, to be able to leverage into more assets. So the overall result of what you're doing is far greater than the little premium that you might be paying on rate.
Correct. If you want the cheapest interest rate, go online.
Yes.
Right. That's where they are, right? These online lenders have super cheap mortgage rates. But if you don't want extra borrowing power or borrowing capacity, if you don't want good customer service, and in some cases offset accounts not available because they're not a deposit-taking institution, it's like, okay,
knock yourself out.
Knock yourself out. You're thinking about cost as opposed to the overall return and strategy.
Yeah, it's price versus value.
Yeah.
So don't be a price shopper is probably that there in terms of... but there is a difference, folks. There's a difference between lending strategy and borrowing capacity. So go for the strategy over the capacity is what we're saying here is number 2.
And it's a brilliant segue into number 3,
go for it.
Which is work with an investment savvy broker, not a bank, right? I mean, there's a layup here.
Yeah.
The first layup here is why would I go to a bank for 3 products when I can go to a broker for hundreds of products? Makes sense, doesn't it? I mean, the bank's got their 3 products that they can offer me, really. A fixed loan, right? A standard variable loan, or a line of credit. That's it.
Yeah.
I mean, there's honeymoon rates, introductory rates, and a few, splits and so forth, but that's all they've got to offer me.
Yeah.
Right? So the stuff that I'm more interested in as an investment savvy mortgage broker is, what's the borrowing servicing like? What's the credit conditions like? How do they treat my rent in terms of rental income? How do they assess my existing lending? All of those things make a massive difference to the amount of money that I can get access to if I'm going to be leveraging into property sensibly.
Yeah, it's a mindset thing too, isn't it, Ben? If you're actually going to be buying a house for a principal place of residence, typically you're only going to have one loan.
Yeah.
And so therefore you get the bells and whistles you need for that one loan. But a property investor is getting multiple loans, so they should think like what a property investor would think, and therefore have some, going back to the earlier point, some strategy rather than just a capacity. So you can go to the bank, you can get a capacity, but if you go to and we've said here investment savvy.
Yes.
Because you can go to a mortgage broker who doesn't know what they're doing, Ben.
No.
You need to go to an investment savvy mortgage broker so that they can help you play the game of chess when it comes to lending.
Yeah, I mean, I think also you'll see that if they've, investment savvy mortgage brokers should also understand how you need to organise your money as well. So, if you've got a cheap loan product that doesn't have offset, then you're going to have to work out what you do with that surplus cash. Yeah. Where you're going to put it. Or it doesn't have a good credit card with a 55-day interest-free period. So all of a sudden it's like you're going to have to work with a different credit card provider, which means that it doesn't auto-sweep. So if it doesn't auto-sweep, it means every month you've got to remember. And if you don't pay it on the day that it's due, then you're going to be hit with a big interest bill. And all of a sudden all that good work that you've done. Everything automated and organised is also highly valuable to anyone who's looking to invest in property and get back into their gardening.
Yeah, good point, because you can actually manage your money in autopilot.
Correct.
Pretty much so that things happen for you. So absolutely, if you're in the weeds with money management each and every month, paying bills, all that sort of stuff, you haven't sorted out a system. So number 1, Ben, acknowledge that the landscape has changed. Number 2 is think 3 steps ahead, i.e., like a game of chess.
Yep.
Number 3, work with an investment savvy broker, not a bank. And number 4 is ensure your conduct is squeaky clean. Data is now being shared. If the occasional bill that you've paid overdue, Ben, the overdrawn on balances, that sort of stuff used to be able to go unnoticed.
Correct.
Not anymore.
So pre-GFC, Bryce, we had what we call negative credit scoring, which meant that your credit file would talk about the amount of defaults or late payments that you may have had, right? So a lender would go and get a credit score done. You know, you would authorise that in your application, and they'd get that credit back from My Credit File or Avida or someone like that, and they would look at that and they'd go, that's interesting, a couple of late payments and one default on a classic one was the home phone, right? Yeah. Oh, that was when I was renting with a mate. I didn't know my name was on the rental agreement. I didn't have the phone wasn't with me. I didn't realise. So big strike against your name. Took a lot of time and effort to get those those things removed. And in some cases, you couldn't get them removed. Yep. The world changes, right? We go to a positive credit score now. So all of a sudden, if you're getting recognised for the inquiries that you're making, and they're seeing the conduct. In other words, no news on those things is good news. Yeah. Because I'm not seeing anything come up on the file, so there's going to be more of this. And they are sharing it, right? So in the past, so we usually have two big lenders, mortgage insurance companies, and they wouldn't necessarily share data. So you go and do a loan with one lender. So these are all the people who are trying to buy 10, 15, 20 properties, right? And this is what they do. They sort of game the system, go and put this lending with them, and then, Genworth wouldn't share that information over here with QVB or whatever it is, QBE. So, all of that would now, bang, sharing. Yeah. So if people were being cheeky and fraudulent around saying I didn't have all this other debt, no.
So if you're about to lend, you need to have a run-up, Ben. You need to make sure that it's squeaky clean in the lead up to, as far back as possible. Yeah. But if you've got a few chinks in your armour, make sure that just before you're doing some lending, there's a decent precedent that the most historical records for you is pretty clean.
Yeah. One thing I can guarantee you, Bryce, is that the world has definitely changed forever when it comes to how much as an individual, so mum and dad households are going to be able to borrow. So we've talked about this before, but you're not going to be able to get the 12, 15, 20 properties. They've cut that out. And I don't think they'll ever relax that to a point. They may relax lending and borrowing capacity to owner-occupiers a little bit more, but the investor is going to have to buy 3, 4, 5 great assets, potentially over a 20 or 30 year period. That's the way in which the game's going to be played in the future. So your conduct and how you do that, if you've got an X on your file, it's even more unlikely that you're going to be able to get lending.
Oh, very good. So there you go, folks. Make sure that your data is squeaky clean. Number 5, take control of your equity now, which is a sense of being able to, within the existing rules, you don't know if they're going to change any further down the road. So cash out while you can, so you can actually have control of your money while you can. But the caveat for this is it's got to be in the best interest of the client.
Yes.
So it's not as if you've got to know your client, and if they're susceptible to buying, addictions, or if they're susceptible to going and blowing it on a holiday or a jet ski or whatever, that needs to be taken into account. But the brokers, we talked about this before, the brokers were getting noted in the Royal Commission about how they would obviously borrow more money than if you went to a bank, which is kind of makes sense if what we've been talking about. Yep. But there's been a change, so the brokers don't actually get any commission or upfronts for drawdowns, and they actually don't get paid any trail until they spend it. So it's not as if the broker now is giving advice that's in the interest of their own back pocket. It's around controlling your own liquidity and controlling your own cash flow, so that if anything changes and the handbrake actually does go up instead of down, as you suggested previously, that means that you've locked in access to your money.
I think one of the things when you get regulation in any environment, right, in any industry, is usually the regulation, especially in financial services, is delivered to the lowest common denominator. And that's challenging, right? Because what it means is advanced and more sophisticated people who are financially literate and who are money literate are penalised. Now, how the government juggles around that is they have high net worth statuses. So if you earn over 250,000 or 400,000 or whatever, you're a significant investor, and so you don't have to play down in the weeds, right? But I have met people on my journey, Bryce, who are young, super sophisticated, whether they be share traders or whatever. I even know someone who set up a self-managed super fund with $30,000. Right now, the minimum standard that they want that we all talk about is 150, 200,000, right? Well, this person said, no, I am confident enough in the research and the knowledge and what I've learned that I can turn that money into a better return than what I could do by giving it to a third party. In fact, that's penalising me, right? So this is what happens. We get regulation down to lowest common denominator. And this is a perfect example of where we are seeing now through the interim report from the Royal Commission and the Productivity Commission and ASIC's review, is that they are worried about the fact that mortgage brokers have higher lending than what you would get through a bank. Now, there's a couple of simple reasons for that. We mentioned it before. I go to a bank, there's 3 loan products, and there's one credit policy, right? And that one credit policy caps me out on my borrowing. Right? If I've got 35 lenders, then the scale of lending that I can do is different. And I've talked about this before on the podcast when I use the example of first home buyer saying, oh look, our budget's 450, but then they come in and they want 500, right? Because they've found a nicer property and all of a sudden they can afford it. Now, when we talk about taking control of your equity now, as a duty of care I have for you, as an investment savvy broker, is I want to understand your objectives, not just for today, but for tomorrow. And I think that's absolutely critical. You know, family, education, all those things that are going to be big cost items, I need to understand what you're doing. But I also love the idea, and we have been huge advocates, because in our minds, we're talking to the 20% of people. You know, so I love the reviews we get. They talk about how it's great for beginners, but also sophisticated people get some gold in our podcast as well. I am talking to those people right now. The sophisticated investor will absolutely release equity when the value is at its peak, right? And they will park that equity. Now, the banks and the regulators, the broker used to get paid to the full amount, right? That's what we were talking about before. It's no longer the case.
It's changed.
But if I'm still doing the right thing by that customer, I would absolutely still release all of that equity, even if I'm not getting paid for it, right? And it goes and gets parked in because it's the right thing to do for that small group of borrowers, right, who are keen to accumulate wealth. I would not do that for a first home buyer. I would not be stupid enough to be looking at doing something for people who have no interest.
Horses for courses.
Correct, but you know, we deal with people who want to have life-changing financial peace. And we've got an obligation to do that. Now, if the regulators come in and say, we think that that's not in the client's best interest, then I will throw my hands in the air and say, well, what should I do? You are robbing them of opportunity to make changes, not only for them, but potentially for their generational family's wealth.
Yeah, because when we recommend that they do that, we actually keep cash flow in mind to make sure they have buffers that they can afford it. So it's actually giving them safety and security rather than putting them, hock them to the eyeballs, and then they're on the bones of their backside trying to fund all these loans.
So that's why I get a little bit of hot under the collar, Bryce, when these types of things come around, because I just don't feel that. You know, I think regulation is important, right? I've always believed that, and I think the work that APRA did, I acknowledge them for that in terms of slowing down what could have been a train wreck, right? But it hasn't been a train wreck yet, and now they've got to be more sensible about that.
Well, the challenge is that people do take advantage of it, though. So you can see why they do the lowest common denominator. So it just means that people have just got to be savvy about who they're getting their advice from to actually navigate these waters.
Well, I mean, my thinking goes a bit like this, Bryce, in terms of, if we're going to regulate like that, what is the opportunity for that sophisticated investor who doesn't have the high net worth now? Could they go and do a course? Could they go and get a qualification like an exam where they have an exemption, right? Because how we regulate, and this is where I do get a little bit frustrated, is we regulate based on a complete blanket approach. And again, that keeps robbing these people. So if we're going to do that, I would like to see the government sort of look at ways in which they could say, you know what, have you gone and done that 2-week course and you sat the exam and now you've got an exemption card? So you've been tested on money management, you've been tested on understanding. Now, I don't know how that looks yet, right? But that's my early thinking on that. Because if we do go to the extremes, we will ruin the ability for people to have a go, to take, you know, who are educated, But like what you were talking about before, they didn't have any excuses. They want to be in this environment, and some of them go and get advice. And this is why I've always said, if you regulate property investment advice, you'll do just as much good as what APRA have done.
Yep.
Right? If you regulate the industry, then all of a sudden you've cut the spruikers out. So those people who do, the spruikers who did take advantage of people to sell them on this dream that's not going to come true because they've bought bad properties, they're out, right? And then all of a sudden we've got a sustainable industry that's going to be well served for everyone who wants to say to themselves, I don't want to rely on government. I'm not, government is not here to provide for me. I'm here to provide for me, and the government's a safety net. And I will see it as that way. But if the government keeps taking away the opportunity for me to provide for my family and to basically be self-sufficient, then what do they expect? I mean, they're going to expect that everyone's going to be looking at government and saying, well, you did this to us. Now look after us until we're 100.
Yeah.
Not cool.
Yeah, cool. So number 5, take control of your equity now. Number 6, don't be afraid of lenders' mortgage insurance. Ben, I always say that embrace it when you have to, avoid it when you can. That's largely because a lot of people don't like mortgage insurance because they're thinking about the cost. And in some cases it can approach $10,000, other times it can be 20, 30, right? But if it's a reasonable amount, I would invite you to have a look at the mortgage insurance and don't just look at that side of the ledger, have a look at the other side, because what that allows you to do is maybe buy a more expensive asset, which the compounding benefit of that is significantly greater than the amount. So I get that people are often price focused, and sometimes up front it seems like a lot of money.
Yep.
But lift your eyes, see what it means in terms of what you're saying before about self-funding, the bigger picture, what does it mean for my strategy? Because if I can borrow that little extra money, and let's say it costs me $7,000, sure, I don't want to pay that.
Yeah.
But if it means that I can do something better with it, you do that. And after talking to your accountant, this is just a general, that mortgage insurance is deductible, Ben. So you typically over 5 years.
Yep.
So you can actually get some tax incentives from that. And if you change the loan in the future, it actually the remainder becomes expense straight away. So the point is, mortgage insurance is very simple.
Yep.
Avoid it when you can, embrace it when you have to.
Can I give you an example? Literally this morning, I was reviewing one of our advisors' plans, okay, and this particular person, single person, works in the bank, demonstrated excellent saving capacity, really good at managing their money, so financially sophisticated, good, saved up a nice deposit. Now, our recommendation wasn't to buy a property until almost 2020, so I think it was December 2019, right? Yeah. So now, they could have potentially done this. Now, this is going to be an investment property, right? So my feedback, because they had their advice from the bank that they worked for, right? Now, the bank, it's an 80% loan to value ratio, so it means no LMI. So my feedback to our advisor in reviewing that particular plan was, I get it. Looked at their profile, low, moderate risk, good, okay? But they do need to be aware, and it's what you were saying before, embrace it when you have to. If the market is moving quicker than you can save, then aren't you better off striking there to get some of that uplift, as opposed to if it's not moving at all or if it's detracting, keep saving. Right? But this is an investment. So there's a little bit of a story here, right, in terms of, for owner-occupiers, I've always said that. If you're a first home buyer looking to get into the market and you want to live in a new estate area, that's a lifestyle choice. Good on you for that. I would be very careful in terms of when I would be making a transaction out in that market. I'd probably keep saving because I would have felt that the values are going down, right? If I'm in an established area, I'm watching it very closely. But if the market's starting to move or turn, and if you're in Adelaide, it's definitely moving. If you're in Brisbane for houses, it's definitely moving. In Canberra, it's definitely moving. In Hobart, it's still moving. And even now, Perth, in the higher end of the marketplace, it's definitely starting to move, right? So all of a sudden, it's like, well, I want to get in before because it could cost me more than the $5,000 or $10,000 that I might have to pay in mortgage insurance. But there is an art form to it. So when you are sitting down with your investment savvy mortgage broker, don't just round up to 90%. See if you can get to 88 or 87 or something like that. There is literally thousands of dollars to be saved if you can be a little bit tighter on that. If you
rewind, listen to that. That is just a nugget of gold right there.
So if say your mum and dad could lend you $8,000 or $9,000 and that could bring your LVR down, that could be a $1,200, $1,500, $2,000 saving. That's the type of thing that I'd be sort of looking at in terms of that being a gift. They're the types of things you would look at. So don't be afraid of it, right? It's definitely available there to you, but in the current marketplace, you may, in a lot of cases, be better to save. But this was an investment strategy. So I would be sort of thinking, so I said to Stu when I reviewed the plan, I said, just make sure the client's aware of that.
Yeah.
That's you know, it's, you know.
You talked about low risk profile, Ben. The question is
low to moderate risk.
Yeah. The question is, have you looked at both sides of the risk?
Yeah.
You know what I mean? Yeah, you go that side of the risk, or that one, the mortgage insurance. But the risk is on the upside that you're missing out on all of that.
Correct. But if they were low, really low in terms of our profile, we would probably say that's the right strategy for them. They need a longer runway to.
But even if
get
they're low
educated.
risk, you still got to say, look at both sides of the risk equation.
Well,
because it could be riskier by not doing it.
Correct. Well, we've always said the best time to get into the market is now, because the compounding return that you get, it's not in the first 5 years that you sit back and go, oh my goodness. It's in the last 5 years that you go, oh my God. Like, look at this amazing return that you get because of the power of compound.
Yeah, nice one. All right, so there you go, folks. Don't be afraid of lenders, mortgage insurance. Number 7. Balance interest only versus principal and interest. So we've got a cash flow versus borrowing power issue here, because clearly there's a price disparity between what you can get, Ben.
Yeah.
So at face value, you might think, all right, well, it's cheaper to go P&I. But again, you got to look at the bigger picture. You got to look at it from 30,000 feet here, because it might be worth you paying a premium on interest rate whilst you're going through the accumulation phase, so that you can actually get the next property which fulfills the plan to self-fund, versus taking a narrow view that, I just want to minimise my costs, therefore I'll go P&I, which might limit the next purchase, what might limit the ultimate goal. So that price disparity needs to be sort of looked at in the phase of where you're at. Am I in accumulation or am I in debt retirement phase?
Correct. We look at it this way. In the past, pre these changes of 2015 and beyond, we were always interest only, right? We were always interest only, even on your owner occupied property. That was it. We wanted to be in control of liquidity. When you start to see 50, 75 basis points difference, that's thousands of dollars a year. So all of a sudden it's now, okay, we need to pivot from that position. And if we're in debt retirement, then absolutely we want to be P&I. We may even be P&I on the owner-occupied property, but certainly interest only on the investments until we've got that non-deductible debt paid down. And if we are in that really strong accumulation stage, that early part of accumulating a portfolio, our rule of thumb based on risk profile and their comfort, and explaining the consequences of both models, because that's the beauty, right? When you can sit there and say, here's this, and you can buy one extra property, or you can buy that property 3 years earlier by going interest only, and that's the net return you're going to get into the future, versus, no, here's you going P&I, that pushes that next purchase out for 2.5 years, and you miss out on that before retirement. Just pushes your retirement out. So everyone goes, I'm happy to pay that little bit extra to control more assets, and that's the power of interest only. So it's not for everyone. Again, I'm talking to that 20% of people who want to make a real change. You can still build out a portfolio of 1 or 2 properties. It's not going to be life-changing. It's not going to be, it won't earn you a self-funding retirement. Combine it with a good super, you'll give you a comfortable retirement, but ultimately it's really 3, 4 properties that get you to that life-changing, self-funding retirement.
Well said. So far we've done acknowledge the landscape has changed at number 1. 2 is think 3 steps ahead, lending strategy versus borrowing capacity. Number 3 is work with an investment-savvy mortgage broker. Number 4, ensure your conduct is squeaky clean because your data is now being shared. Ben, number 5 was take control of your equity now. Number 6 was don't be afraid of lenders' mortgage insurance. Number 7 was balance out interest only versus principal and interest. And number 8, Ben, debt consolidation.
Debt consolidation, Bryce. So this one's a simple one, right? A layup. When you can consolidate your debts into a lower cost debt, you can get greater borrowing power. Now, that's great if you're in an accumulation phase. It could also be a case where it may not be appropriate. Right? If you've got a 3-year term on a car loan and you're not good with money, and you are just doing that to basically so you can continue to spend discretionary wise, stupid idea.
Don't do it.
Don't do it, right? But if you are all about making sure that you're putting that money to work harder for you, you don't want to leave that money on the table, you want to be able to create wealth, then you need to sit down with your investment savvy mortgage broker and work out the pros and cons of consolidating that debt.
Well done. Don't think much more needs to be said on that. So that's number 8, debt consolidation. Number 9, we're bringing it home, Ben.
We are.
Bringing it home with loan-term resets. This is one of the strategies on how to buy an investment property without impacting the family budget.
Yeah, so I mean, you know, it's a beautiful segue from debt consolidation, right? Because that's exactly what that does too. You know, what it does is it's minimising your repayments, which means that technically you can borrow more. Exactly the same way as loan-term resets. Now, Bryce, we have a Facebook group, right, for our Money Smarts.
We do.
And there
You've
was
been very active in it, Ben.
Yeah, there's a great. Well, I said.
Who said you weren't going to go on Facebook?
Put your questions up there, and I'll answer them. And there is a great example in there about when we were talking about repayments. Oh, I was worried about, you know, P&I. That's going to be another $1,200 or $1,500 extra a month. You know, that's going to kill your strategy. Yeah, it is if your loan term's 12 years to go, right? But if you were to reset your loan terms back, so still remaining principal and interest, but set your loan term back to the full 25 or 30-year term, all of a sudden your repayments are significantly lower. You are then able to, you just said it, Bryce, release that surplus money and then put that surplus money to controlling another asset.
As long as it's an income-producing asset that's likely to go up.
Correct. An appreciating asset.
Yep, exactly. So there you go, folks. There's the 9 ways to navigate the credit crunch, including those last 2, debt consolidation and loan-term resets. Closing thoughts, Ben?
Well, I just want to explain how that works. It's important that we make sure we explain why that changes the repayments. So a loan amortisation occurs over a period of time. So if you've got a 30-year loan term, that's 360 months of repayments. Now, if the interest rate doesn't change, you can see it. You know, you see those charts where they just show that line starting from where the loan balance is down below. Those earlier years, the majority of amount that you're paying is interest. Later on, it's principal, okay, because you're paying less, because they're set repayments, right? And so there's a breakdown between the principal component and the interest component. So if you reset the loan back to a 30-year term, ultimately it means that you're paying less principal, which means your repayments are lower, okay? They're lower, and that's where the gold is in terms of releasing that surplus cash.
Mate, bringing up the old days when you were a mortgage broker.
I know.
Hey. Very, very good. So, folks, I'm often said, Ben, we've got to summarise. So, just to quickly run through that again. Number 1, acknowledge the landscape has changed. Number 2, think 3 steps ahead. Number 3, work with an investment-savvy mortgage broker. Number 4, ensure your conduct is squeaky clean. Number 5, take control of your equity now. Number 6, don't be afraid of lenders' mortgage insurance. Ivis, thank you for that. Number 7 is balance interest only versus principal and interest. Number 8, debt consolidation. And number 9, loan-term resets. Ben, I think that was a really good framework for people to help navigate the credit crunch. All right, Ben, so today my life hack is largely around the fact that people who listen to this life hack might just go, come on, Bryce, you're a bit late to the party, right? So I'm throwing it out there now.
Oh, mate, if there's any chance for me to have a go at you bring it on.
Yep, so set yourself up. But just because I'm travelling a lot and my phone, I have gone and purchased one of those recharge batteries that's thin, fits in nicely so that I can extend the battery life. So given that we were just on a 16-hour flight.
And the fact that you needed to borrow my charger says to me that, do you charge the backup charger?
No, tell the truth, Ben. I needed to borrow your USB cord so that I could put my phone into the charger because I'd actually checked my cord through in my checked luggage. That's a life hack in itself to make sure that you bring that on the plane.
How do you charge something if you don't have the cord to charge it, Ivis?
So you borrow Ben's, and then he runs the risk of not getting on the flight, so that he doesn't actually have a cord.
Maybe there's a life hack where you have a cord attached to you permanently. I don't know.
All right, I'm happy with that life hack. So irrespective of that heckling, and irrespective of you undermining what a great life hack that is, folks, get one of the spare battery packs for you, so that you can charge your phone and you're not without a charge.
That's terrific, mate. As long as you have that charged.
I said I could be late to the party. Ivis, have you got one? No, Ivis doesn't have one. Do you have one?
No.
Well, there we
It's
go.
not my
Let's
segment.
Hey?
It's not my segment.
You don't even have to have a segment for these life hacks, mate. I'm just dropping pearls of wisdom on you. If you want to pick them up, you can let them go.
I struggle just organising my segment once a week.
Well, all I'm just saying is you've pre-framed your Did You Know
I have.
in a way that this had better smash it out of the park or I'm coming for you. So, Did You Know?
Well, it shouldn't come for me. I mean, I'm just
right.
highlighting a couple of important points. So yesterday,
Is it good?
Yeah,
Is this a good one?
No, yesterday, Westpac Melbourne Institute Index of Consumer Sentiment, right? This is important stuff, Bryce. This relates to the cost of money and potentially about how the economy is performing at the absolute grassroots.
All I'm saying, it's all about the delivery, mate, so bring it
Well,
home.
I'm trying my best. If you don't keep interrupting me, I think I'll get somewhere. All right, so it rose 2.8% for the month to 104.3 for November versus 101.5. So the previous couple of months, consumer sentiment had been falling, right? So this surprised me because I think there's a bit of negative sentiment out there, right? So I was like a bit surprised. So after a couple of months of negative, we've had a little bit of a spike, okay, in terms of what that looks like. Now, what it does, just so you know, without getting into too much technical detail, is it measures confidence in the next 12 months and confidence over 5 years, roughly using 5 different sort of variables that they look at. So it's 1,200 people that they survey. The interesting one was this, Bryce. Around one of the things that they looked at was time to buy a dwelling. All right, now time to buy a dwelling. So you think about this, confidence in the property market's falling. You know, so sentiment's down, but this spiked 11 points, almost 12 points, 11.8. So it moved effectively from, you know, a reading of 102.6 in October to 114.8 in November.
Right.
Now what does that tell you? That basically says that of the 1,200 people that they surveyed, time to buy a property. So this could be the baseline that we're looking for to see property land a little bit softer, right? So that's a confidence measure. Now, in terms of, and because the alternative measure for that one is what we call the house price expectation index. Now, in terms of that was down 2.3%. So people who own property are going, yeah, property's worth less, probably worth less now because, you know, the market's down and everything's down. So sentiment's down, confidence is down, and we're seeing that drop. In fact, over the course of the last 12 months, 27 basis points, or 27 points that's dropped, right? So 27 points that's dropped over the year. So people are like, my house isn't worth what it was 12 months ago. Good. Yep, but the time to buy a dwelling over the course is up 16%. So we're seeing a surgence of new buyers, first-time buyers, firsties into the marketplace. This is where they're starting to see opportunity. All right, so that could just be a little bit of green shoots in terms of where we land in regards to how much the price. Because if you pick up the paper or online anywhere, there's got to be a crash story. There's a property crash story in.
Yeah, we say it all the time.
Every day.
Predicted 22 of the last 3 recessions.
Because it's clickbait, it works beautifully. It works beautifully to get those ads up. So that was just an interesting one for me in terms of overall sentiment. I still think, you know, we're not on the right side of the ledger. We're in a positive territory. So anything above 100 is optimistic. Anything below 100 is pessimistic in terms of what it looks like. So there you go. Did you know? Consumer sentiment. And we're going to be watching that closely. Also, wages came out. We had a bit of a positive result in the wages. I'm still not sold on the wages story. It's still too much spare capacity and too much casual and part-time work in the economy. I don't think we will. Wages will put pressure on for a couple more years. It's an interesting market out there.
Very good, mate. I did not know that, and you did recover from.
Was all right.
That was all right. What do you think, Ivis?
You learned something.
She screwed up her nose. What do you think?
She did a double thumbs up, and then she gave me this.
She did.
Then she did the shaky hands. You know, like 50-50. I'm on the fence.
So was it thumbs up or thumbs down, Ivis?
Neutral.
Oh,
but it's good information.
Mate, it was good information. It was just maybe you could have just worked on your delivery a little bit, or you know.
Oh well, my phone's charged. Oh, that's right. I've got a charger. Oh, there we go. No worries. Until next week, Bryce.
Hey, I just wanted to know if the consumer sentiment was okay with the Collingwoods, you know, in terms of because it predicts future, and the fact you can never win a grand final. I just wanted to know if the consumer index
we
was okay.
How many have we won?
Well, let's talk about how many have you lost.
Well, how many have we won? How many Freo won?
Well, if we can include South Fremantle,
Bang! Goal!
if we can include South Fremantle and Fremantle, East Fremantle premierships like you guys do back in the VFL, and you combine them with the AFL, then let's talk.
In the league, mate.
Let's talk. Hey, folks, one thing I want to say to you is we're getting more and more people coming onto the podcast, despite the fact that someone said they'd done 2 laps, Ben. More and more people are coming in the last sort of 20 episodes and finding it increasingly difficult to listen to all of our podcasts. That's fine, but what I want to do is give you some advice, is you've got to listen to the first 10 or 12 because they are foundational.
Yes.
And we don't bang on much in the first 12, Ben, because we were pretty rubbish back then. So you could
what do you mean back then? We're still pretty rubbish.
But have you listened to those lately? We were stumbling and stuttering and they were terrible, right?
I've never listened to
them. But they are foundational. So here's the tip. 1.5 speed will help you cut through the lap pretty quickly, and we're working on something at the moment, Ben, to help people keep up to speed as well. We'll tell you that as soon as that's done. So, folks, go and check that out. But Ben, until next week,
knowledge is empowering, Bryce, but only if you act on it.
Very true. See you next week, folks.